Hey students, last video in our chapter 8 series, and this one's on contingencies. So what's a contingency, right? A contingency means it's something that we're just not sure what's going to happen. And sometimes we need to put those on our balance sheet to let people know about them. So an existing uncertain situation that might result in a loss, right? So there's two words you're going to want to know. You're going to want to know these throughout your career, and I've got them here. Probable and estimable, right? Say estimable fast 10 times. Why these words are important is because that's how the accounting rules decide what we're going to do with things that might happen. Okay, so let me just kind of walk you through an example. I'm McDonald's, right? And somebody goes through the drive-through and they get coffee and they spill it and they burn themselves. And that burn, they're very upset about it and they sue me. So, do I record an expense because they might win that lawsuit? Well, what the accounting rules say is if it's probable that they'll win and it's estimable, meaning you can estimate how much you'll have to pay, yes, you have to record it. Now, here's the funny part. How in the world do you define probable? Well, here's the oh so awesome guidance that they give us. Probable means it's likely to occur. Reasonably possible means it's more than remote but less than probable. And remote means the chance is slight. Aren't those awesome? Don't they make it super clear? No, they don't. And then remember, with the payment, we decide whether it's reasonably estimable, meaning we can estimate the amount, or not reasonably estimable. All right, so how do accountants ever decide how to meet these definitions? We sit down with lawyers and we work through them and we try to figure out what we think makes the most sense. For your case and in this class, I'll give you the words and all the problems, like whether something is probable, reasonably possible, or remote. All right, so let's think about this. Here's this grid. Now, I don't tell you to memorize things often, right? Well, actually, you get to use your notes on the test. So this is a good note to have. Because what this grid is telling you is, when do I record a liability? When do I just have to disclose it, meaning I just tell people about it in the financials? And when do I do nothing? All right, so let's look at the grid. If it's probable and it's estimable, I've got to record the liability. That's the only time I have to record it, when it meets both of those things. If it's probable, meaning I think I'm going to have to pay it, but I can't estimate how much, I just have to tell my readers of my financial statements it existed. A great example of this is back during, you guys remember when there was the great BP oil spill? Well, if you look back at those financial statements, they knew they were going to have to pay something. They knew it was probable, but they had no earthly idea how much they would have to pay. So they couldn't record the liability. Instead, they just had to tell the readers about it. And if you pull up the BP financial statements today, they're still talking about it, even though they've finally started settlements and recording things. Okay, then again, what if I just think it's kind of possible that I'm going to have to pay for something, but not probable? This is when there's a lot of unknowns. In that case, whether I can estimate it or not, I just disclose, okay? And then lastly, if it's remote, meaning this is not likely to ever have to cause me a problem, I don't have to do anything. So why is this so important? Because we, as the readers, as the investors, the people that want to go out and invest in companies, we want to know if something big is coming, right? So we want to know if they're going to have a big expense in the future for something that's already happened. That's why if it's reasonably possible, they need to tell us about it. All right, but what's the journal entry when we get to this one? The probable and estimable? Super simple journal entry. We debit loss, we credit contingent liability, and those are just estimates that we put into our financial statements. All right, another kind of contingency is a warranty. So I want you to think about warranties for a second, right? We all know warranties can be kind of a ripoff when we're offered them on everything that people try to sell us. But let's just say we've purchased a warranty, right? Apple Care, right? I purchased Apple Care on all of my Apple products. Well, Apple doesn't have any idea how much they're going to have to spend on warranty claims, right? Now, they've probably got some pretty good historical information. So what Apple does is when you and I purchase that Apple Care, they make an assumption about what it's going to cost them in the future. So let's assume that they say, we think it'll cost us roughly 3% of sales, and sales were 1.5 million. So they record that warranty expense, 45,000, and credit a warranty liability. Now, is that number perfect? Probably not, right? It's just based on estimates. And then when people actually make the claims, right, they lower the liability because people are making the claims, they're using up our estimate. And we credit cash here because we're assuming we had to spend some money to make those warranty claims whole, right? So remember, if we looked at the warranty liability account, we put estimates in as credits and actual payments come in as debits for a final balance. So next topic, contingent gains. All right, here's a really funny concept, right? I always tell you all accountants only like bad news. If it is a contingent loss, like we were talking about with the BP oil spill or McDonald's, yes, I have to go through that process of deciding, do I record, do I disclose, do I do nothing? Contingent gains means I do nothing, right? Accountants don't like good news, so with contingent gains, I will never record it. All right, so I want you to take a minute, pause, try to do this problem associated with gift cards. Okay, welcome back. Hopefully this made a lot of sense to you. iTunes sells $10 million in gift cards, and the customers redeem 8 million of them. I'm sure a lot of people like you and me lost the other 2 million, or they're floating around somewhere in our rooms. But we are going to debit cash when we sell those gift cards and credit deferred revenue. What kind of account is it? It is a current liability. All right. Next, people come in and redeem them. So I'm going to decrease that deferred revenue and finally record sales revenue. Right? So I can't record it in the first entry because I haven't done anything yet. People have just given me cash and I have a promise to give them music or whatever else they want to buy with those gift cards. It's only when they use them can we do it. Now, a lot of times when I go through this in class, people say, but what about all the ones that are lost? Well, that's a really good question. Companies have what they call breakage policies. So breakage means we know as Apple or Best Buy or anybody who issues gift cards that people will lose gift cards, right? Lose? I don't know if I spelled that right. I'm going to put SP question mark there just so you know. I don't know if I spelled it right. So breakage just means yes, we do believe people will lose some of them. So over time, if we have balances that are older, we will slowly go ahead and decrease them and bring them into income. Right? If you ever had a gift card that a company took away money from your gift card over time, that's because they wanted to record it as income. So if you got a gift card of $20 and you went to use it 2 years later, right? 2 years, and all of a sudden it was worth $5, that's because the company was like, oh, snap. If you're not going to use this, we're still going to record revenue over time. So harder to talk about over a video where we can't have a little back and forth, but hopefully you're figuring out what I'm talking about. Okay, last problem, right? In this case, we're going to talk about that favorite topic of mine, probable and estimable. So do this problem. You can use your grid because that's what you'll be using on the test, and give this a try. All right, so remember, if it's probable and estimable, then we are going to go ahead and record it. Right? If we record it, we debit loss, we credit contingent liability. That's scenario 1. Okay? Scenario 2, it's probable and the amount is estimated to be in the range. Okay, so it's still probable and estimable. And so when we estimate something in a range, we take the low amount, and that's what we record. Debit loss, credit contingent liability. Scenario 3. Ooh, now it's, let me turn my eraser on up here so that I don't confuse you guys. Okay, so now it is reasonably possible and it's estimated. Reasonably possible. Well, gosh. Wait, why is my screen not working? Hang on. Let me see what I did here. I don't know why my screen's not working, you guys. But since it's reasonably possible and it's estimated, then I'm going to disclose it. All right, and then I can't move forward to scenario 4, so I will just post these answers online. All right, guys, you did a great job getting through all 3 videos. Good luck with the homework, and let me know if you have questions.